welcome to another episode of ScaleUp SoundBytes. Today I'm joined with Dale Hurley, who has been co-founder of two tech businesses here in Australia. One where he's been CTO, the other where he's worn a couple of hats of COO and Chief Digital Officer. So the first one being CreditorWatch and the second one being Avenue Bank.
Yep.
Thanks for coming on the show, Dale.
Yeah, thank you for having me on, Sam.
Yeah, nice. So I think like when we were chatting before this, there was what we uncovered was the two different startups that you've been a part of have been two different journeys, right?
Oh, absolutely.
CTO at CreditorWatch, and then you wore a few hats at Avenue. Hey, so CIO is Chief Digital Officer.
Yeah. And then just jack of all trades as your typical founder. So, like I was doing policies, procedures.
Yes.
I
saw one of the it was like not get shit done, but it was like get stuff done as like one of the things. It was like model. It was the actual model. Like is that a
getting things started. So there's a book by David Allen in the early 2000s, which was all about getting things done. It's just got this structure of everything that comes into your inbox. There's the 4 Ds, as in do. So anything that you can be done in under 2 minutes, you do.
Yeah.
Delegate. So if it's something you can delegate it out.
Yeah.
Defer for anything that you need to defer to later. And then delete for anything that's just irrelevant or a distraction.
Yeah, I love it.
And then having a time set at the end of each day for anything that you deferred to then work out when you're going to actually prioritize it and get it done.
Yeah, there's that structure in your day. Man, you just that 2 minute thing, you just reminded me of one of my favorite books. It was The One Thing by I think Gary Teller. I think that's his name. I think that's him, Teller. But yeah, The One Thing. And he was the whole thing is just drills in the same concept of prioritize your day, focus on one thing at a time, and then do it. Block out time to do it. And it's clever. He gives different examples of it, but that's it. Like if you can just hammer that home and do that, that's it. And that framework, he goes through that exact same framework, and he goes, if something comes on my desk throughout a thing, and if it takes me 2 minutes to do, I'm just going to do it. Not think about this is annoying or anything. I'm just going to do it. Yeah, because it's not worth my time getting annoyed about it.
Yeah.
And he does that with everything in his life. And as soon as it was like that with my life, like, just something with the kids, or if my wife asks me to do something around the house that I know I should have done, I'm like, I'm wasting mental energy here. Yeah. Fighting that. Just do it.
Yeah, absolutely.
Yeah. And then, because it doesn't take long.
No. It's all about, reducing cognitive load.
Yeah.
And having focus. So, one of the big things I'm all about is white papers. And so it's one of these things where, as startups and scale-ups and even established businesses, there's hundreds and hundreds of exciting ideas that pop up every day, or maybe every week, where a salesperson will be out at a client site and someone will say, hey, shouldn't you be doing this? Or CEO will come back and be like, hey, I've just had this, awesome idea. Yeah. And everyone just jumps on it and totally disregards whatever they're working on. And so you end up with like all these 20 things that are in progress instead of having something complete. So the whole idea of white papers is it's just a one-page business case, and it's really important it's kept to one page, where it's just like, here's my idea. This is why I think it's strategically important. This is where I think, how much revenue it's going to bring in. And then this is, what the resources and what it's going to entail, all on one page. And then you collect those ideas throughout, a fixed period of, say, a quarter. Yeah. And then you take all of those ideas and white papers, and then you set your strategic agenda for the next quarter. And then you look at those papers and go, which of these white papers most align to our 5 strategic agendas for the next quarter or whatever a period that you have. So that way you're not losing these ideas, but you're also not getting distracted with trying to work on 20 different things if they're not fully aligned to what your strategic agenda is.
So those white paper, do you allow, like, if you're putting that into input like that process into a startup and something like that, you say, all right, cool, anyone can come up with these ideas.
Yeah.
Give us a white paper, we'll store them and then evaluate in the quarter and then align them with what we want. Is that
Yeah, absolutely. So cool. At CreditorWatch, we literally put them on a pin board.
Yeah.
And so everyone could see the ideas. They could put pen comments on it. One of the things that's really good about being in the office together is you can have those ideas.
Yeah.
People could write questions on it and that sort of stuff. So it wasn't just like I'm creating an idea in isolation. I'm creating an idea as a part of a collaborative team. Yeah. Obviously, now with advances in collaborative software, you can take that methodology and put it into solutions like Confluence.
Yeah.
There's those, or Notion. It's really important is just having those ideas out there and letting them sort of resonate and have some time to bake to work out, is this idea actually worth doing, or are we just rushing into something and totally neglecting what we actually had strategically said was important?
I heard someone say this, it was like that dopamine rush of a new idea is like, it's like crack cocaine for founders or entrepreneurs, right? Like I get all the time being business owner, it's just like I get an idea in my head, or we'll come up with one PR and we'll like think it's going to solve the world, change the world of recruitment, and we'll invest some time in it, and then just like, but I don't want it.
Yeah.
But at least, but then at least we're like, all right, cool, that's it, done. But then we just gotta let it go. Like,
yeah. And I think that you've really hit the nail on the head. Is one of the big things of being an entrepreneur and a founder is you're just constantly looking at things and going, that's broken, I can fix that.
Yeah.
That's broken, I can fix that. That's broken, I can fix that. And Mark Boris, he's really great in his podcast, The Mentor, and he's always hammering in. It's about focus, and relentless focus. And it's one of the big things I really take away from him. I think, he really knows that how to operate a business, and just having that operating rhythm is really crystal clear.
Yeah, enjoy your stuff. Yeah, I actually did business with his son. So,
oh, really?
Yeah. He was one of the co-founders of Managed App. I think he's exited it now, but we helped scale that team, a Ruby on Rails team. Yeah. All right, cool. So CTO at CreditorWatch, and then you wore a few hats at Avenue. Hey, so CIO is Chief Digital Officer.
Yeah. So the first one, CreditorWatch, we started that in 2010. There was Colin Porter, Patrick Coughlin, and myself. We're really tight, coherent team. We worked really well with each other, and CreditorWatch was one of those amazing sort of companies where, as a startup, we found product market fit really early. Customers loved us. You had two dinosaur incumbents of Dun & Bradstreet and Vita at the time. It's now Ilion and Equifax. So they have absolutely dominated the top of the market, your enterprises, your banks, and your big end of corporates. For the small and medium businesses, they had like products that were like $125 to get a credit report on a company.
Yep.
If you're a small and medium business, $125 for a credit report could be eating almost half your margin.
Yep.
And so it was sort of a big problem that Colin had with his publishing business, Loyalty Media. And he just went, we can solve this. We can use technology. And so I was at Accenture at the time, absolutely killing myself, working sort of extremely long hours. And saw the article yesterday in AFR about Accenture management consultants talk about overtime, where you end up earning less than minimum wage.
Oh yeah,
when you take into the hours.
Yeah, right.
But it kind of a bit. I'm like, well, getting into management consulting, it's not exactly a secret that you're going to be working 80 to 100 hours a week.
Yeah. reasonable extra hours.
Yeah, they were not reasonable extra. But it is one of those things. You go into management consulting, you do start off as a graduate and it is long, hard slog. But then as you move up, you get so many opportunities, you learn so much on an accelerated pace that you just wouldn't learn if you go through a normal 9-to-5 job. So yes, it's long and hard hours, but it's also, you just got so much upside in non-financial rewards if you can stick in and and do it.
They turn out to be financial rewards later.
Yeah, absolutely. Oh, yeah. We've all seen in AFR the PwC partners and what their salaries were. So pretty astronomical. And so there is that longer term game. But so I was working there. I'd been previously a management consultant at IBM, at Accenture. The department I was in, we were trying to really go after a space that Accenture wasn't in at that stage. They're in now, but it was more trying to compete against your McKinseys, your BCGs, and we just weren't winning projects. So we were working these extremely long hours, working weekends, and Colin's like, hey, I've got this idea. Do you want to come and build it for me as a freelance thing? And I'm like, I can't. I just don't have the time. And then I arrived in, I think I had worked an entire weekend, got to bed about midnight on the Sunday night, was back up for the 6 a.m. flight down to Melbourne. At a client site, and I was really struggling to stay awake. And I'm like, why am I doing this? So when I got back from Melbourne, I had a chat to Colin to say, well, instead of me trying to build this as a freelancer, how about I come and work for you? And that's how we got into CreditorWatch, was from the foundation, in saying, let's build this thing. We're going to really focus on data automation, data processing, and analytics and AI, which really was transformational because the incumbents, they were manually processing the notices. So, a court notice would come out, they would get the publications, and then they'd manually put it in, and you would have, say, a 2 or 3 day lag in alerts. So our focus, and then we also looked at what other data's out there and how else can we get it. And so being a scrappy startup, we were really forced to be innovative and resourceful. And so we'd just be like, hey, ASIC's now publishing insolvency notices. That's really awesome data to have. And then saw they've created a Google sitemap and went, oh, cool. So if we've got the sitemap, we can just use data scraping to go, we know what the new publicized notices are each night, and then we can just scrape the data and then start publishing it. And so that sort of innovation was just something, again, the incumbents weren't doing. They went, there's insolvency notices that CreditorWatch is publishing, and they just then started again, manually transcribing it. It's like, it was just that old school way of thinking where we were just forced to have to use technology to solve problems. And so that really put us on a trajectory. We had a great market in the small to medium businesses who were being ignored by the incumbents. We had a great technology set where it was very much focused on our customer base as small to medium businesses. We had CreditorWatch for the credit reporting, ApplyEasy for credit onboarding. Again, that was a product that really helped us move up the market a little bit in terms of, you had these credit managers who, for them, they'd been in a job for maybe 20 years. They hadn't really brought significant change or innovation into the business. We brought into them this thing called ApplyEasy, which was suddenly they go from a paper-based credit application to suddenly having, showing their business that, hey, I've introduced this online credit application. I can process a credit application within 5 minutes. Don't have to transcribe the manual handwriting. We got real-time credit report, real-time referee checks, and we can go from maybe 2 weeks to process a credit application down to a few minutes.
Wow.
And so it was just massively transformational for them to actually show, hey, I'm bringing innovation to the business, and instead of being a blocker to the sales process, I'm actually now accelerating the slow process, which really allowed us to move up market. And then we really focused on them in terms of creating things like their data wash, which then they could just upload their age trial balance, which gave us amazing data. They got back in return a report that told them, for all the debts that you have, these are the debts that you're most likely going to be able to recover, because we can see that they pay their other creditors within 30 days. And then here are debts that you're very unlikely to recover because they're either not paying any of their creditors, or they've gone into external administration or have a whole heap of court judgments and stuff. And so all of a sudden, again, they were getting much more efficient at their jobs.
Yeah, so your clients are, okay, I get it. So your clients they were coming to you to analyze the data or the debts that they had. Like, that was one of the tools that you could provide them with that data.
Yeah. So if you say got like 50,000 customers, and then you've got all these invoices. So you say you're George Weston Foods, you would be able to say, so they make products like Tip Top and a lot of the pet foods. You've got a lot of customers from like your big supermarkets right down to your mum and pop corner stores.
Sure.
And so it's really hard for someone to be across, what's my 50,000 customers, and then what's my likelihood of being able to recover, and then how do I know which debts I need to provision for to be able to just write off and get them off the balance sheet.
How good. I remember using, my old business used CreditorWatch, and I think it was like $50 per check or something like that, because I mentioned before we were talking about check, it was like 100 and something towards, I think it was something like that. But it was like that. So whenever I was because we used to do them to check out new businesses, contract recruitment, because there's a much more higher risk out there because we've got people on site.
Yeah, absolutely.
We're paying them for a week and waiting for them to pay us. So when people are on like $1,000 a day or something like that, it's over 1 or 2 weeks, that's 10 grand we could be out of pocket before we see any dollars in, and then pay. Anyway, so we'll do a credit check on that, and usually it was come back, it was instantaneous, of like a red light, green policy and stuff like that as well, which is quite cool. So that was the one-soft product. We also, which was what was like the traditional incumbents. And then we also had the subscription model, which was nothing like what the incumbents were doing. Right. Maybe that's what it was just like you can use it whenever you want.
And which was really a big change as well, because all of a sudden as a small business where you're going, do we want to get this report and then keep refreshing it every 3 months?
Yeah, of course,
Or do we just want a subscription where, we get an alert if there's actually any change to our customer? So, you do the credit check, you click then monitor for alerts, and then, 3 weeks later, they go into administration. You're getting an alert that day to say the XYZ's gone into administration. And you can immediately get onto the phone and say, how I want my bill paid, or you can get on to the administrator and go, I want to put in a claim because this is what this company owes me, instead of,
waiting.
Waiting.
Or not knowing.
Like, we had one customer who, during the sales pitch, they got the sale. He was like, okay, give me a demo of the product. And he looked up one of the customers and he saw that there was an alert, and he ran out to the warehouse and stopped the pallet of stock going out, because he was like, Yeah, and so
It's hilarious.
it's
Real time. That's it. Yeah, don't send it.
Yeah, and so it's just having that really important information, because it's a very asymmetrical relationship when you're a vendor, to be able to to your customer, because your customer will hopefully know exactly the state of their financials, where you're just, as a vendor, got whatever information they're provided, and you're just sort of hoping that they've been honest and that they're paying their vendors on time.
Yeah.
So that one,
That was like, so it sounded like it was, right time, right product,
right
price. Yeah, right for disruption.
Yeah.
And then like almost like a couple of ways you were disrupting it as well.
Yeah, absolutely. It was, disrupting it, and it was classical, proper disruption. So like, you go to the innovator's dilemma. You had, this end of the market, which was just largely ignored, and Vita and Dun & Bradstreet really focused on their traditional way of providing value, where we were really focusing on, well, instead of trying to do this pay-per-clip sort of thing, we were like, let's just do subscription. Completely changed the model on top of its head, and it really gave us that foothold into the industry.
Yeah, fantastic. Okay.
And then,
And then Avenue.
We sold CreditorWatch in 2017. One of the big problems that we had in it was bank guarantees. You probably have a bank guarantee for this premise.
Right.
So it's sort of like a rental bond, but instead of providing the rental bond to the real estate agent, you go to your bank and you get a bank guarantee, which is a letter from the bank to the landlord to say, on presentation of this letter, we will immediately pay out to the face value of the bank guarantee, no questions asked.
Sure.
Which is great for landlords, because they're not having to take a rental bond, hold it, and then go through the process of claiming a rental bond in the event that there's a default, where they have to go through the process of proving that there's a default. So it works so much more efficiently for commercial leases.
Oh, okay.
And so,
what was that issue for you guys at CreditorWatch?
Yeah, so we had pretty much every single issue that could happen with a bank guarantee go wrong. So there was, the biggest issue was the fact that we had over 600,000 tied up in bank guarantees, and then we were raising capital of I think $1 million. It's like, we've got 60% of this money just sitting in a term deposit, which was just insane. That we were,
You can't use it.
they can't use it. Like, literally, we're out raising venture capital to when
You've got the half the money there, more than half the money.
Which was crazy. So that was the biggest thing. The next thing is we had issues getting a bank guarantee for our Sydney premise, and so our lease had finished at our old premise. The bank was taking forever issuing out our new bank guarantee. We're like, well, we're going to be on the street. We've got to move. So literally just moved into the office without the bank guarantee. The landlord was pretty upset about it. But yeah, we were just in a situation where we had given the money to the bank. We had gone through the whole process. We were just waiting for that bit of paper to be issued. And I think it took 6 or 7 weeks for that bank guarantee to come to us. My co-founder of Avenue Bank, when he met with his relationship manager at Westpac, he's like, "You're the reason I started Avenue Bank." So it's like, it was that 7 weeks that you took, and we were in this really stressful situation that caused it. And then we had, with our Melbourne office, the bank guarantee go missing from our old premise. So we ended up, you can't unlock the money because the landlord's lost the bank guarantee. And so...
But the money go?
Well, the money's still held by the bank.
Oh, right. Yeah.
And so it's going through this, rigmarole of trying to go to the landlord. And I think it was an overseas landlord. So they
lost the bank guarantee.
They go missing all the time.
So it's like a bit of...
It's a bit of paper.
Oh, right.
It's literally a piece of paper, which is insane.
Yeah, that is insane. So that's like tied up where the money is. So without that, you can't...
Yeah.
Yeah.
So so it's a piece of paper and that the landlord holds on to. And landlords are great at tracking these pieces of paper. They've got, like, they'll have in their CRM system which filing cabinet it's in, whereabouts that filing cabinet is. Unfortunately, the office that they've got in their CRM was one that they terminated the lease on about 5 years ago, and they have no idea where the filing cabinet is.
Oh, right.
So that's a continual problem, and that's for both the tenant and the landlord, because the tenants sort of, when they need to claim on the bank guarantee, they need to physically have it. And then for the customer, when they're terminating their lease, they want to be able to free up that money.
Get that money back.
Get that.
Like what you guys.
Yeah. So we had to go through a process of getting this landlord to sign a stat dec to say, I won't make a future claim on this bank guarantee. But I think they were an overseas landlord, so they were a bit funny about signing these documents because they're just a bit unsure about it. So we had money tied up in 2 bank guarantees at once. That was insane. So those 3 problems were like, when after selling CreditorWatch, we're like, we can solve this with bank guarantees. So we set out to start a bank. Naively thought, how hard could it be to start a bank?
They're popping up everywhere, right?
Yeah, absolutely. One every week, right?
At that time, it was one every week.
Yeah, I think it was more, there was just a few, but they were making a lot of noise.
Yeah, that's right. That's alone. Yeah, but there were a few.
Yeah. So you obviously had Tyro and Judo, who were, they both went through quite a hard process. I think it took Tyro something like 13 years to get a banking license.
Yeah, but they were a bit different though, because they were always operating as a payments facilitator, right?
Yeah.
I remember going to a startup presentation where the guy was, and they were more of established, and he was talking about his experience with other investors, and the guy from Tyler, I can't remember who it was, but it was like, they were telling, we've got to start operating more like a bank.
Yes.
Yeah. Really been into it. Yeah, Judo was the other big one.
Yeah, so you had Tyro, which is what was the crux for Scott Morrison at the time. He was treasurer.
Yeah.
He went over to the UK and saw the restricted banking license system over there.
Right.
And went, this is an opportunity to be able to create more competition and innovation in the Australian banking system. Let's create a restricted ADI pathway.
Okay.
Which sounded great. It was an awesome initiative in theory, but in Australia, in the Australian, we're obviously a much more conservative country in terms of taking risk. And so when it sort of landed with the regulators, it's like, but we've got the most stable banking system in the world.
Yeah.
Which is awesome.
Yeah, our banks are the most, all 5As and stuff like that. The best banks in the world, I think. We're part of the top 10, all 4 of them or something.
Yeah.
Right, yeah. Consistently, year on year.
Yeah. So awesome that we've got the most stable banking system in the world, but it also means we're limiting competition, we're limiting innovation. And so where this original idea around the restricted banking license is if you become a bank within 2 years, it ended up taking us 6 years.
Yeah, right.
Like, which is just an insane amount of time. And so we set out, we went, how do we start a bank? And that was where I took a 3-month sabbatical from CreditorWatch, went and sat in a dark office in one of our investors' office. So I think they were using it as a storeroom before I sat in there, and they cleared it out. Yeah, exactly right.
Scale's office.
Yeah. Hey, look, I mean, better than nothing. So, which was awesome that they were like, hey, you can have some privacy to be able to take this off. Engaged with Ernst & Young. And for 3 months, worked really, really hard on our first banking application, had an awesome licensing team. They really understood bank guarantees, understood the pains of it, understood that our solution. So we were looking at it for solving multiple issues at once. Our first issue we wanted to solve was the deposit. We're like, instead of having 100% cash back, so say you needed a $150,000 bank guarantee, you would only need $15,000 deposit instead of $150,000. So you're freeing up $135,000 for small and medium businesses right at a crucial time that they need that money freed. Because if you're moving between two offices, you got a lot of money demands, like you got the fit out costs, you've got moving costs, and all that relocation costs. So freeing up that money was a massive benefit. We were then looking at the time of issuance. Which has been one of my biggest initiatives, was like, how do we get this issued as soon as possible? My ultimate goal was, could we issue it in real time? Unfortunately, because of AML and payments, it's just not possible. But we got it down to 24 hours, which was awesome. So, if you've got 6 weeks is what sort of some of the incumbents is doing, you're doing it in 24 hours, all digitally online. The biggest hold up in that 24 hours is, like, say if you've got 5 directors, getting all 5 of them to complete the AML process, or KYC.
AML, KYC.
And then the next thing was digitizing the bank guarantees. So they just couldn't go missing.
Yeah, of course. And seemed like the most simple thing here, right?
And which
You're
is
telling me this,
And landlords love the digital bank guarantees because they've got they've got several different concerns about bank guarantees. First, is the bank guarantee real? When we're out interviewing landlords, they're like, we've had doctored bank guarantees given to us, and we only find out that they're doctored when we go to claim them.
Right.
Second was, as I said, they lose the filing cabinet. So they know which filing cabinet in, they just don't know where the filing cabinet is. And then finally also just staff fraud. So unfortunately, you've got these instruments which could be worth in the millions. It's not hard for a staff member to be able to pocket one of them on the way out, and then in the future make a claim on it. And at the time, there wasn't pay identification. That's just coming in now with the banks.
Right.
So it's really easy, until pay identification becomes standard across the banking industry. It's still really easy just to go, oh, this is my account name. Like, of course, I'm Landlord Proprietary Limited. As the account name, as no one knows. And so it's good now that the banks are starting to do that verification, but more needs to be done on that. But that was a big problem for the landlords is, unfortunately, some ex-staff got alternative motivations, as we've seen. And so they could slip one of these bank guarantees away and make a claim on it. And so Avenue has gone out to solve those in multiple different ways. As unfortunately couldn't get approved by APRA to do the 10% deposit. They're working on APRA to get that, but that was one of the things that we had to sacrifice to get our license. It's still like something Avenue sees as going to be a real game changer.
What are you guys settling on then?
So it's...
Well, you don't know. So what are you settling on? Sorry. So it's not 10%.
24-hour issuance.
Okay.
And the digitization of the process. So it's biggest problem.
So still not 100%.
With the 6, unfortunately. Hopefully can get that changed. But how long that will take is dependent on the regulator. But the 24 hours, if you're sort of 2 weeks out from moving into your premise and your landlord goes, hey, we need a bank guarantee, you can't wait 6 weeks for your bank to get it to you. So Avenue's partnering with a lot of the landlords and leasing agents and property managers to say, we can do it in 24 hours.
Yeah.
The customer gets us their data, they get us the deposit, we can issue it out in 24 hours. So that's really important for all the members of the leasing ecosystem on that fast issuance. So that's, well, it's not the end goal, it's still a great differentiation in the market compared to what's out there.
Comparing the two journeys there, what was the main differences? So it sounded like when you were talking to me on the phone and the journeys that CreditorWatch seemed to, it had that ripe disruption. You had the need there, customers, you had that identified target market already, they're itching for it, and it absorbed and seemed to pretty smooth.
Yeah.
For like those 8 years.
I
wouldn't say but it sounded like basically like a startup dream, the way it was described. That you had the technology, it was ripe for disruption, time for it, and you overheal, and then you guys managed to exit and sell.
Yeah, absolutely. So like, the way of thinking about it is all startups is a marathon. So it wasn't like CreditorWatch was this super easy thing to get done, but it was a really fun journey to do it, and there was a lot more ups than downs. And even in the downs, like we all really, we had such a fun, vibrant culture. Avenue was very, very different, and it's because I said to you on the phone, it felt like a bit of a shit show in terms of just, it always seemed something was going wrong. And we'd take 2 steps forward and then it would be 2 steps back. And so the journey was more like an ultra marathon pushing a pram. And that was because we were, when it was CreditorWatch, we controlled our pace. We went, we want to get things done. We want to have this big, hairy, audacious goal that we're going to work towards. This is the pace that we're going to set, and this is how we're going to work towards it. And we could push as hard as we wanted. And our limitations was just ourselves and resources and capital. But we were able to just go and really go for whatever goal that we wanted to get to. Having a regulator there is so much harder. So we started off in 2018, super awesome licensing team got the product, and then we made our first submission and the licensing team got changed. And we sort of, at that stage, we didn't fully appreciate how much that change impacted. It was sort of like, we've already done all these presentations to the previous team. They already got it. What we didn't realize is there wasn't a handoff on the back, in the background. So the new team, they didn't even know what bank guarantees were. And it took us a few months of meeting and talking about bank guarantees, and then them coming up with funny statements to us suddenly realizing they don't know what a bank guarantee is. So they were thinking a bank guarantee was more the financial claims scheme bank guarantee, or the guarantee that, if maybe a parent or something puts over a guarantee. So this licensing team weren't aware of what bank guarantees were for commercial properties.
And got the power to give you the guarantee.
Yeah. Well, to give us the license.
The license, sorry. Not
sorry.
The license.
And so it was, and that was our fault because we had explained it to the previous team and just assumed that the new team had done it. And that was fine. We worked through that. We worked with the licensing team, and 2019 was a bit sort of stressful in sort of trying to work with this regulator who they set a bar at a certain height, and then you've just got to work out how high you got to jump to get over it, and you only find out after you jump whether you've made it or not.
Yeah. This is an analogy. It was just like being a high jumper without knowing how high it had to go. Right?
Yeah, exactly right. And so you, all you get back is we're satisfied or we're not satisfied, and which is frustrating. But we got
sounds like some like clients in recruitment actually. Hey, look, if you about these candidates, now you're going to get a yes or no. It's great for your candidate experience.
Yeah, exactly right. So we got the application submitted. We worked with this new team, and then we were capital raising at the end of 2019, heading into 2020. COVID hit, which was one of those things where just did not expect it, to the point, I think it was December, I was sitting with the chief risk officer talking about, all the different policies that you need to do for a bank. One of them is a pandemic plan. And she was laughing that this is the most redundant exercise that banks have to do. A few weeks later in 2020, here we are going, shit, we need to put it together. Which is fine because we were a startup. But 2020 hit. Obviously, all of a sudden, all venture capital was like, we don't know what COVID means at the time. And so we were running out of runway, and then suddenly you had the collapse of Zinja, one of the other neos. They had
just and then
they were a neo startup. They listened to APRA on, at the time, the licensing regime was just create a deposit taking bank first. Don't worry about trying to create asset income generating products, which is kind of problematic. And that's why we were fighting APRA for a fair bit, because we're like, no, we want to create a sustainable business model, which means you launch with something that's income generating from the start.
100%.
And so Zinja, they had launched just with the deposits, and they tried to capture as much deposits as possible by putting up their interest rate on deposits above the market standard. And so all of a sudden they were just hemorrhaging money, and where they thought that they could get APRA to approve their income generating products in time, APRA just didn't get them that approval.
So that's how they fell down.
Yeah, so it was obviously a big risk to launch in the way that they did, but I think at the time, all of us in the neobank industry thought that we could get products approved much faster than what they were approved. So you had the collapse of Zinja. And anyway, there's lots of multiple factors there. It wasn't just the regulator there. It was COVID hitting, and they thought they had 450 million raised, and that the investor behind that pulled out. And so
I remember I did a bit of work with a company called Doe, and they were sort of pitching themselves as a neobank at the time, but I don't know, they're kind of like an investment platform now. But Andy Taylor, the CEO, we were talking about this, and Zinja and Volt, they didn't collapse then, but we were talking about they were sort of competitors at the time, and he was explaining to me, it was like, they're all marketing themselves as these, do-good banks that are like giving you more back with the higher interest rates on your deposits and stuff like that. But they're not going to make any money until they disclose how they're going to make money. And the only real way that they're going to make money is by mortgages. That's the most easiest way for a bank to make money. So it's just like, they're all just going to be doing the same thing. And then it sounds like what you just explained, until they couldn't get those money making assets online. Just gone. Yeah,
exactly right. And COVID was probably the biggest problem there. So with the COVID hitting, the collapse of Zinja, us running out of runway, we had to do an emergency down round, which I don't know, like for any founder who's raised venture capital, doing a down round is one of the worst things that you have to do, because
what's a down round?
A down round's where your price is less than what your previous raise price was.
Okay.
So say we had our Series A at price at $1, and then we did this emergency round at 36.5 cents.
All right.
So massive discount.
Yeah.
Which no one's happy at that point. Like your investors, your staff who have taken options, your everyone. No one loves it at the
So people who invested you at $1.
Yeah.
Now seeing so like minus 67.
Yeah, and there was some anti-dilution balances in there, but they still they don't average you back out to the price. You end up you're still less. You're not made whole at that stage, and so we raise the emergency fundraise. We then have any of the staff that remained, so we made redundancies, but any of the staff that remained went down to 3 days a week, which is not great as a pandemic breaks out, because we were a new entity that didn't have any previous income. There was none of the government payments and stuff available. So JobKeeper, I think it was called.
Yeah, JobKeeper.
So so none of that was available to us. And then licensing got suspended. And it was just indefinite.
Yeah.
We're putting it on suspension to be reviewed in 6 months. And so it's suddenly like, holy crap, like shit. Well, everyone, like, there's just no certainty. Like, staff don't know what's going on. Your investors are like, what does this mean? Yeah. And then it's the board and the executive team is like, we know as much as you guys do. Like, we talk to APRA, and what we're getting is the same public statement that's out there. So we're not getting additional information. And then also at that point, my co-founder had stepped away from day-to-day operations as we appointed a new CEO, because we were looking at, for being a bank, you need a banking CEO, someone who's had that experience and that in governance and risk stuff. So he had stepped away at that time as well. So it was just a lot of instability in the business. And that instability continued because then you had the when finally APRA went, we're going to set it only to 6 months, the suspension. They then expanded it out by another 6 months. And so ended up having 12 months of this suspension. Luckily, the new CEO, George Confos, he worked with Liberty Financial and secured an investment from them into Avenue, which then really gave us the ability to ride out that period. Not that it made it easy, but at least it got us through to the next thing. Then we're raising our Series B, which in the middle of it, Vault collapses.
Yeah. It was Vault collapse,
and again, it was the same.
So was that bad for you or was it good for you?
It was horrific for us.
Oh, right.
Because you not only had Vault, you had neobanks around the world collapsing. You had Credit Suisse collapse.
Then like a year later, Credit Suisse collapse. I remember that. Yeah. And then the Silicon Valley, that was probably a bit later.
Yeah. They were in our Series C. So Vault collapsed to our Series B.
Yeah.
And so we had investors lined up. One of the investors that was lined up, who was going to be taking a big part of the Series B raise, they were one of the early investors into Vault.
Oh, right. So
lost a lot of money. And so it was just sort of this time where you just like, we thought we were back on track. We thought things were going right. And then, and Vault had the same sort of, they didn't go out and have massive interest rates on their deposits, but they were just constrained with being able to get income producing products out to the market.
Yep.
And so
they had the same problem, but
same problem. And then there was this new licensing, like they modified the new licensing regime to try to create more stability in the banks, which was like, you have to launch with an income producing product now, which was like, yeah, we know, like this is business 101. Like, so, and then it was just multiple times we had lots of problems where we would just be like, we're getting low on runway, executive team, you either need to go down to 4 days or we're going to pay you in options, or we're just going to have a period where we have to forgo income. And so that's all in the investor comms. And so those sort of periods really took a big toll on the team. And it was really, we had to build a lot of resilience, a lot of grit.
And that's not the first time you guys happened. So it's happened a couple of times.
Yeah. And, because of the amazing team that we had and how they pulled together, we managed to get to 21, where we got our restricted ADI license, thinking, this is great. Yeah. 2021, we're thinking, this is great. 2-year time frame, the clock's ticking, we got to get to it. APRA's on a mandate to have to get this done.
I remember talking to Vic at that time, and it was a lot more optimism.
Absolutely. Yeah. And then we were accelerating, and then Heartland Bank announced that they were going to do an acquisition of Avenue. They made a strategic investment into Avenue for their acquisition, and this is in 2022. And so we really focused on, what is it that the new Heartland Australia Bank is going to look at, put all of our resources into there. And then in October of 22, we'll give it a few minutes notice to say Heartland's pivoting to, there's an announcement coming out, that Heartland Bank is going to pivot to purchasing Challenger Bank instead of Avenue, which was just totally unexpected. And because we'd been having their executive team in our office, we had some of our executive team go over to their office, and we've done lots of joint meetings between their different departments and stuff. And so, we're getting into the office, and I think I heard about it. I was on this Harbour Bridge, get to Wynyard Station, and the article's already out there, and staff and friends are starting to call to go, hey, what's going on? And you're like, no idea. And so at that point, board we're thinking, let's just shut down Avenue.
Yeah.
And I'm like, no, this is the time to dig deep.
Yeah.
And so I think we, 2 hours later, having a meeting with the major investors and the board, and there was the proposal, let's shut it down, let's return whatever remaining funds, because one of the big things about being a bank is you've got lots of reserve funds. Okay. So when I say we're running out of runway, it's like, yeah, but we're the most well-funded company in the world running out of runway.
Right, okay.
Because it would have just, it was more running out of runway before we hit our potential reserve problems. But so there was the proposal, shut down Avenue, let's return the remaining of the funds to investors. And I was like, I've got a different idea. This is, the alternative is we slash costs, focus back on the original business before Heartland had proposed to acquire us, and let's go forward with just a really focused, lean bank because we already had 90% of our systems and processes built. We were there. We just had a few milestones that we had to get over, and it's like, so luckily the major investors groups agreed. They got behind it. They put a bit more money into Avenue to keep it going. It did mean that we had the departure of the CEO, and then we went from 50-something staff down to just under 20 staff within a few days, which obviously is quite horrific. And then there was a few more rounds of redundancies after that. But, with the new CEO appointed, Peter Piper, she really embraced the vision of a lean, focused bank that's going to get its license. And so it was really amazing how we were able to transform quite rapidly through one of the most difficult moments to then go, let's get our license. And so we spoke to APRA. APRA was agreed. They actually then started committing to timeframes. Unfortunately, they didn't keep those commitments. But luckily, because of the support of Liberty, who kept going, okay, guys, we've seen you've made the radical changes. You're listening to us. You're working. You're not just spending money without certainty, because that was a really important thing to them. They're like, work with the regulator, but conserve spend until you've got certainty from the regulator. And it was the big thing that they just wanted us to listen to them about, which absolutely makes sense. This new CEO, Peter, she really worked well on going, okay, I'm going to be focused, going to be lean, going to make sure that there is no unnecessary spend in the business, and we'll get our license.
Just get it done.
Which worked really, really well, because then even though APRA took a bit longer than what they had said, they were working with us. We got into a much better relationship with them. And then at the start of this year, they let us know you're moving into, end of last year, you're moving into fatal flaw, which is a horrible term.
Right.
But what it just means is we're absolutely satisfied that we have found every single hole in your business, that you have all the mitigation strategies in place, and then we're submitting it to an independent committee who will do an assessment just to see if there's anything that we've missed that's fatal to the stability of the bank.
Fatal flaw.
Yeah. And so with that, we got the full banking license in March this year. As I said, unfortunately, without the partial deposit for the bank guarantee, but at least they're in the market, getting bank guarantees out there.
Yeah, fantastic.
Yeah.
All right.
So
how good. All right, this is, I went into this chat not knowing much about anything. Now I feel like I'm an expert in both credit industry and commercial bank loans. Ask me anything, guys. Okay, what felt better at the end of the day?
definitely CreditorWatch.
Yeah, right.
And look, it's it's interesting. Like,
so sometimes struggle isn't the
we had struggle in both, but there's one where you're able to control the outcomes. And then one where you're just sort of at the mercy of someone else, and
and the global pandemic.
And
the industry factors, and it sounded like there was a hell of a lot more.
And I think there was a big thing there during the pandemic. People's resilience was quite affected. And I think so. You found that you having to have a team and try to provide motivation to them during those times was quite difficult, and so I had a lot of people outside of Avenue constantly trying to say, "Why are you doing this? Just give it up. It's over, and focus your efforts." And I think, again, that was probably a macro depression where people just weren't looking at things of there could be possibility of you can just work through this period and come out the other side.
Yeah.
Obviously, I proved them wrong.
Yeah.
But it's one of those things that was just a time where people just were different for a little period.
Yeah.
So,
Yeah.
where CreditorWatch, it was good times, lots of partying and fun. And I think that was also a bit of cultural difference. People at Avenue, they were nice people, really friendly. They worked hard and stuff. But if the parties that we had at CreditorWatch just never would have flown at Avenue.
Yeah, right.
CreditorWatch was all about big celebrations, lots of fun. We were a scrappy startup with no money, just getting by, doing things differently and having fun. Like, one of the things that was like a real testament to it is Matt Jackson, who's still the Chief Commercial Officer at CreditorWatch. He introduced this monthly thing called the Hoedown.
Right.
And it was a way of really lifting up the whole business to demonstrate what everyone's working on. And so you would have, because traditionally, sales teams, they have their end of month sitting around going, this is this is how much we close each month and stuff. But then expanding out to the whole business. And so sales would go, these are the significant deals. Engineering would be like, these are the features. Marketing would be like, these are the programs. Finance, who no one talks to, would be like, hey, these are I've got our collections down by this amount. I've got these results. And then we also had editorial arm as well. And they were presenting some of their successes. And the big thing is it wasn't run by the leaders. It was strictly the leaders can't present. So it had to be different team members getting up, and then the whole company was celebrating every different department's success. And it was just a monthly rhythm, lots of memes, lots of laughs. And it was just, everyone knew, I think it was 4:00 last Friday of the month. It was tools down, and we're just going to have fun and celebrate each other.
Find out a bit more what each other do and stuff like that as well.
And so, it wasn't that town hall sort of thing. It was more, it was just that, and that was just constant.
I remember the one of the companies I used to work for, we had a similar thing, and CFO would do that the hoedown thing, and he's the most awkward guy, but everyone's glued to it the way, because it's like, this is a lot of finance, and it was like always the most boring stuff, but like make it so good. And at the end, it's like, that's finance. And we'd be like, let's go. It's so good, like.
And it's so important because it elevates these people who are traditionally seen as back office. They just keep things in motion to actually elevating them to say, hey, we get sales is important. Everyone understands why sales is important. In tech companies, we understand why engineering and products is important because they were creating the engine. And then these other support functions, they just generally get ignored. And so it was a great way of really elevating them and making them prominent in the business and saying, they're not just some people doing busy work. They're actually really keeping the business going and actually really having massive impact on the business.
Yeah, for sure. Yeah, it's so important for that culture.
Yeah.
All right, Dale, mate, I appreciate you being here, mate. Thank you so much. I think, I've learned a lot, and hopefully people listening to this, watching this, will too. I think there's so many good nuggets out here, so thanks so much.
Thank you.
Cool. And you're looking for work at the moment. So I want to throw a shout out there. So if you want someone who's been, worn a couple of hats, CTO, Chief Digital Officer, I've got the battle scars to prove it. Reach out. Reach out to us. Reach out to Dale. We're around and take the calls.
Excellent. Thank you.
3 last questions to finish up. Favorite book?
Yes, Scaling Up by Vern Harnish.
Okay.
So it's based on the Rockefeller habits, and it's about having a quarterly rhythm to your business, and it's an operating rhythm. And so that's where the white papers sort of come from, but it's also about making sure you identify the responsibility, all of the different tasks to be done in your business, making sure you've got someone responsible for them, identifying then your BHAG, so big, hairy, audacious goal, putting that as like the center of your business, then planning it out. What's our 5-year goal? What's our 12-month goal? What's our quarterly goal? What are the words that we own? And then pushing that out to the business. So big thing is, leadership doesn't set strategy in isolation. After your quarterly strategy session, you have a town hall. Everyone's brought in there. You discuss your successes of the previous quarter. What are our lessons learned? And that's really important. The book emphasizes it massive. It's like, leadership shouldn't operate in a vacuum. They should really collect feedback and understand, what didn't work, what could we improve on, and then presenting out the new strategy where you go, okay, this is our strategic agenda. These are the top 5 strategic objectives for us. And then these are the white papers that we've selected that we're going to deliver in the next quarter. And then just having that continual operating rhythm in your business to be able to, it talks about the exponential growth, so a multiple of 10 growth at on each increment. So moving from 1 million to 10 million to 100 million to 1 billion.
Wow.
And so they're sort of saying is your plateaus of growth. So really good books and an operating rhythm that I'm a real big advocate of.
Yeah, fantastic. Yeah, it sounds really, I haven't heard that one. So it's always good. I'm a big advocate for books and knowledge and learning, continuous learning. That actually sounds fantastic. Yeah, and it sounds like a couple of things that, are drilled into you, like the quarterly review cycle, monthly review cycle and stuff like that, but really breaking into why and how it benefits scaling up. A lot of that leadership shouldn't be in a vacuum. Yeah, I think that's the most frustrating thing when I've been in businesses. Yeah, you see these decisions get made or talked about. Yeah, or you hear it with the rumor channel through a business. That always happens. Yep, and you just don't know, or you don't see the benefits as to why, or no one's bought into it, and it just happens and rolled out because of that.
Exactly right. Yeah, it's really, really important to bring everyone on the journey and have their buy-in because they trust you and the rest of the team.
I guess, I get companies aren't necessarily a democracy. They're more of a, not so much a dictatorship, but like it's kind of like a hybrid boat where decisions need to be made up top. Yeah, you still need to get that buy-in, can't you? You still need to get in people.
Yeah, and I mean, the best way to get motivation is if people feel that they're jointly owning it.
Yeah, skin in the game.
Yeah, exactly right.
Yeah, in the same time, like that. Yeah. Okay, cool. Who do you think would be the most influential person in your career and why?
Great question. One of the people I really admire is Reid Hoffman. Yeah. Founder of LinkedIn. Yeah. He's got the book Blitzscaling.
Misha.
I really listen to him closely. He's got his podcast. I forget what it's called.
He comes up my thing.
I can remember it's Green and Blue. I can't remember everything else about it. But he's really good, very insightful, very encouraging of the startup space. Extremely wise and smart, and I think he really is been influential on sort of how I think about business.
Fantastic. If you were to name a quirky habit of yours that contributes to your success, what would it be? Doesn't have to be quirky.
Quirky, yeah. So I think it's always been this, never giving up mentality.
Sounds like you got that, yeah.
Like, even when everything just sort of seems quite doomed, I can, be the one person who can still see the light at the end of the tunnel. And so you just sort of keep going on. And then back to the other side. So when you were saying about like entrepreneurs and founders like to just build solutions, it will be that constant. There's a problem, I'll just make a solution for this. So, we were like at Avenue, there was a discussion about how do we do the draft bank guarantee, and I was going around committees and stuff. I'm like, this is crazy. I'm like, we could generate a draft bank guarantee in real time, and there was lots of discussions about how hard it could be. And I'm like, it's not hard. And so I took 2 hours because I'm still a hands-on keyboard at times, and went, here we go. We can generate a PDF in real time just using a little bit of JavaScript, and it's like problem solved. We don't need to go through 20 committee meetings to get this solved. We can just do it. And so that's probably a little quirk is, I like to continually find technology solutions that can solve things and quite quickly.
Yeah, fantastic. Awesome.
Yeah.
All right. Thanks, Dale. Thanks.
Excellent. Thanks, Sam.